report that as a long-term capital lease. But we have to either own it or control it for it to be an asset on our books. Then acquisition, the transaction or event giving the company the right to control the benefit has to have already occurred. It makes sense. It can't occur in the future because then we have no control over it yet. It has to have already happened for us to be able to record it as an asset on our books. Liabilities are future sacrifices that we are going to have to give up. We're going to have to give something up from a present obligation we have, and to fulfill that present obligation, we're going to have a future sacrifice in future years. A loan. The benefit of a loan is we receive money now, but isn't a loan an obligation that we have to pay it back in future periods? So a liability is something that we've received a benefit, but we have a current obligation that is going to require future sacrifice, money. It could require future services, but something we're going to have to give up in the future. A company's obligation must have all of these to be recognized as a liability. A transfer, it must involve a responsibility that we have that will be settled by a sacrifice. Now that sacrifice can be transferring assets such as cash, transferring equipment or things that we own to settle it. It could be we have to do services in the future to pay it back. But an occurrence of a specified event that has already happened that we need to satisfy in the future. It has to have an obligation. It must obligate the company so that there is little or no discretion to avoid the future sacrifice. It's very clear we owe somebody and it's going to require future payment. And it already had to have incurred. So the transaction, the borrowing of money, the taking out of a mortgage, that has already obligated the company. For it to be a liability on the books, it had to have already happened. Okay? Equity is just the residual difference. Remember that, you're going to see it again. Equity is the residual difference between the assets a company has after the liabilities are satisfied. Okay? So equity, the residual interest in the assets of a company after deducting the liabilities. Now, we have three types of equity. We have what we call contributed capital, which is basically the shareholders, it's probably stock. We have an account called earned capital, which consists of the retained earnings, which is all of the money that has been the net income of the money minus the dividends throughout all the years of existence. Then we have a piece called non-controlling interest. This will be a section that if this company owns an interest in another company, we will report it in our equity section to show the ownership of minority interests in other companies. So that is, the equity section is broken down into three scenarios: contributed capital, earned capital, and non-controlling interest. So I'm not going to worry about that.
Quick question back to non-controlling interest.
Yes.
That would be like if U.S. Bank invested money in your company, not borrowed your money, but invested it, and they had a money, and whatever money they made back in dividends from that goes on their books as non-controlling interest?
Correct. And there's different ways of showing that investment depending on the percent of ownership. But basically what you're saying is exactly right. When a company doesn't borrow but truly has stock in another company, depending on what that investment is, it needs to be reported on the books as equity, a non-controlling interest in their equity section of the books. Okay? Yes.
Okay, and hopefully, I was a little late, I apologize. I mentioned this before, but the terms recognize and realize, are they the same or not?
Not always, no.
Oh, sometimes they are and sometimes they're not, because that was kind of confusing in the first.
When we realize income, there need to be certain aspects related to when income is realized. So, for example, we realize income when we have completed the service, okay? Now, recognizing it relates to reporting it,
Okay.
okay? But realizing the income means we really have done all the work completed in order to say, yes, we have earned that income. It's been realized, and at that point, we can then recognize it on our books.
Recognizing is the recording.
We can record it in our books.
Okay.
Okay?
Thank you so much.
You bet. And I'm sorry if I mix up words.
No,
That happens
it
sometimes.
was in a term earlier. You didn't. I just was
Okay.
thinking about that.
Now, the one aspect, I'm just doing a review from last week and then we'll carry forward. I said I wasn't going to do this, but I'm doing it. So, most of the items we're familiar with on the balance sheet are recorded at historical cost. What is historical cost? It's usually what we purchase something for. Okay? The cost of an asset is measured by the cash we paid for the asset, and with that, we may include the shipping of it, the cost to get it place it into service, to test it. So it's not necessarily just that particular asset, but what it involves to get it working. For liabilities, the historical cost is generally the initial obligation of the amount we owe. So historical cost of an asset is the amount we initially pay for it. Most of the assets on our balance sheet are treated at historical cost. However, rules have been changing ever so slowly. And now, certain types of assets get recorded or recognized at using present values. That's what the current value of the asset is. So, monetary or liabilities initially are recognized in the financial statements using an interest rate appropriate for the particular financing arrangement at that time. For monetary assets and liabilities that are due within 1 year, GAAP permits companies to ignore the discounting for the time value of money. So basically what they're saying is certain types of monetary assets we're going to record at present value. What does that mean? If we have an asset, let's talk about a liability. We have a liability today of $100,000 that's due in 10 years. Based on the time value of money, is $100,000 today worth $100,000 in the future? So we will record the present value of that money. We need to pay $100,000 in the future, but it's probably going to show up on our books as less than that today, because that's $100,000 we owe in the future. Make sense? So we'll talk about that. But no, there are some items we're going to record at present value. GAAP requires certain types of assets and liabilities to be measured at fair value. Now, the types of assets that are measured at fair value relate to trading securities and investment securities available for sale. What does that mean? A company invests in 3M 10 years ago. They bought it 10 years ago for $60 a share. Since then, it has split and split, and their $60 cost acquisition prices may be worth $110 a share. Since certain securities are available to be sold right on the spot, they want those to be recorded at fair value. What's the real value of this monetary assets or investment sitting on our books? Okay? So we won't record that 3M stock at what we bought it for historically 10 years ago. We'll show it at the fair value rate today. And the reason we do that is we could just click a button and sell that stock immediately. It's on the stock exchange. It's easily tradable. Okay? In a way, it can be converted to cash quickly. Therefore, we can treat it with the fair value measurement.
Can I ask you, since we're talking balance sheet, which is a snapshot sort of
Yes?
thing, it's the time that you're doing the balance sheet. I mean, it could have been theoretically different a few weeks ago.
Yes.
Or,
And so we have to record that amount based on the end of that day, December 31st, what is the fair value? Okay? You know, stock can dip 30% overnight, but it's as of that snapshot. Okay, fair value, I'm not going to worry about that. There is also situations in which we will use something called a recurrent replacement cost to record assets. Current replacement cost is basically what a company would have to pay to replace an item. Okay? Net realizable value. No, I'm not going to talk about that right now. There's so much to talk about, and I just have to really hone in on what matters here, okay? So on the balance sheet, we know we start with our assets. Then we record our liabilities, and then we record our shareholders' equity section. Assets are classified into various groups. We have a current asset section. We have long-term investments, property, plant, and equipment, intangible assets, and other assets. So our current assets are those assets that we can convert easily into cash within the current operating cycle. Current assets generally are cash, cash equivalents, inventory, accounts receivable, and prepaids. Long-term investments are going to be an investment that is going to be way over a year, one operating cycle. Property, plant, and equipment, those are those assets that are used in the operations of a business. Intangible assets are those assets that have value but we can't see. Goodwill, trademarks, patents. There are liabilities. We're going to define those into certain categories also. The current liabilities generally need to be paid off within the current operating cycle. Long-term liabilities, sacrifices that are due past the current period. Shareholders' equity, we're going to spend a lot of time talking about the various sections of the shareholders' equity. So again, current assets, cash, liquidity. Here you see current assets, cash, investments in available for sale securities, such as 3M stock, accounts receivable, and inventories, along with prepaid items. No, you might have on your test, this type of account is what kind of asset? You'll need to know, is it a current asset, a long-term, property, plant, and equipment? You'll need to know. So various types of current assets, make sure you go over this at home. Current liabilities, obligations the company expects to satisfy within the year or the current operating cycle. Another type of current liability are deferred revenues. We also call them unearned revenues. They're usually monies a customer will give us up front for work we need to perform or a product that they want to purchase, but we